Hello everyone, I am Terry and this is my client Jason. Today we gonna talk about how important to include bonds in your portfolio. First, let's start with what is bond. Typically speaking, bond is a type of security that the issuer owes the holder a debt, and is obliged to provide fixed cash flow to the holder before the maturity. At the maturity date, the issuer will pay the face value of the bond to the holder. This is how bond works in the real world. There are several types of bond depend on who is the issuer. Issuer of bond could be government or corporate. A bond coupon rate could be higher with a longer maturity time. Today, we will mostly focus on government bond. As an investor, what is your most concerned about bonds, Jason?
Could bond make money for me?
Okay, so let's take a look at the rate of return of bonds and stocks in the US since the Great Depression. Stock market provides 10.11% annual return during this 97 years period and bond market provides 5.7%.
Wow, it seems like I should only buy stocks to make more money.
If you only care about the annual returns, stocks could be your choice. However, during we make decision in financial market, the safety of our own money is important too. Stock market is more aggressive. You might earn a lot but also could lose a lot. In the picture, we can see the standard deviation of stock market is much higher than bond market and also in few decade, return of bond is almost the same as return of stock. My point is more clear in this chart.
What is T-bill? I think T-bill is safer than both of them.
Yes, T-bills are zero coupon bonds with short maturity period ranging from 4 to 52 weeks. T-bills could give limited profit. Thus you could buy some T-bills when you feel the market is going bad. Back to the chart, we can see there are few years return of bonds even higher than stocks. With less risk and considerable return, why don't you think about adding some bonds to your portfolio? Let's simply make in combination with 60% of stocks index and 40% of bonds index and see how it performed start from 4 economy crush time point. Our return rate is even higher than the only stocks index since the dot-com bubble. From these two start points, returns of stock outperformed much than returns of bonds. However, our combination still work well with less exposure to potential risk. Now, will you start to consider to buy some bonds? Jason.
That's really interesting. I'm starting to look at bonds now.
Great. It's always good to enrich your investment portfolio. Don't put all eggs in one bucket. Bonds are not really risk-free securities, especially corporate bonds. You should do more research on those corporates when you consider to buy some bonds issued by them. Your bonds could worth zero if the corporate bankrupt. Also for government bonds, real interest rate and inflation rate are important elements. Before buying bonds, one should always focus on government's fiscal policy, monetary policy and economic conditions. This is all for today. Thanks.